JP Morgan said the strength in the labor market means a majority on the FOMC still likely to be more concerned about doing too little than too much. Sounds like you think
I agree with
that's
that.
the case.
I think we'll see the equivalent of a steady as she goes message today from Chairman Powell. Don't think there'll be a real signal on a pause or a pivot, because that would be premature. We'll see a 50 basis point hike. I think we're going to see early next year one or two more, probably 25 basis point hikes, possibly 3 depending on the data. But the one thing the Fed cannot afford to do, because it's had a tough year, it misjudged the tenacity of inflation. It sent mixed signals. The one thing they can't afford to do is ease off too early and declare victory and then find that actually victory is not at hand. So it's just not in the Fed's interest to signal the job is almost done, we're almost there. I don't think we'll see that.
But the street is primed to look for changes in words like ongoing rate increases to further rate increases or some rate increases. Do you think they're wary of that as well, of being so granular the street's going to take any sign of a hall pass?
Well, I wouldn't like to be Jay Powell today because he can't win. What I'm sure he'd really like to do is a version of Jackson Hole. You read a statement, you don't take any questions, you get off the stage. But of course, the format now the Fed has with the press conference doesn't allow that. But I think there's a tremendous tug of war going on within markets in the following sense. We have been in a period for 3 or 4 months where bad news economically has been good news for equities, because investors see the bad news and they say, wow, the Fed won't have to be higher for longer as bad as we thought, so let's buy. And that, I think, still pertains today. But I worry that sometime soon we're going to get into a phase where bad news economically actually is bad news for markets, because the recession risks are rising. I think they're quite high myself. And earnings are going to be under pressure next year. Valuations seem high to me in relation to what may be the earnings flow next year. So we may be transitioning sometime soon into a market where bad news actually is bad news.
I'm sorry. You're saying those things, Roger, and of course I'm thinking about the role that I know you typically play in terms of advising companies, whether on a deal or just in general. So is that what you're hearing from a lot of CEOs? Do they expect earnings to come down next year? Are they being particularly cautious as they approach 23?
Of course, every business is different, and you have some companies whose business remains very strong. I mean, for example, in the food and beverage sector, consumer food and beverage. But most CEOs say the following: business is still okay, but I think it's going to get worse. That's the message I hear most often. They don't usually translate that all the way because they don't know themselves into saying earnings are going to be down 11.4% or that, something like that. They don't know themselves. But I think there's just a widespread expectation, and you see it in the surveys. I mean, Evercore does surveys of investors. Other firms do regular surveys of CEOs. They both show, as you know, almost 100% agreement on the likelihood of a recession, which would mean lower earnings. Doesn't mean they're right, but the expectation of weaker business conditions next year is universal.
So in light of that, I guess, what are you hearing? How are you advising in terms of navigating things like M&A, where to put investments to work, especially in light of the fact that we've had this nearshoring and reshoring and supply chain diversification trend that continues? Hirings, I guess, versus firings.
Well, you got several questions there, Morgan. I think CEOs are a lot like investors in the sense of the tug of war I mentioned, where people, someone said on this network earlier today, I was watching, markets want to go up. And CEOs want to think that business conditions won't be terrible. They may get a little worse, but they won't get that bad. It's just human nature. And in that spirit, you can see that even though M&A volumes are down a lot versus last year, compared to pre-COVID levels like 2019, they're really not bad. And even this week, whether it's Amgen or other deals continue to be done because there's a lot of pent-up interest on the part of decision makers in business combinations. I would say one big uncertainty, though, that's new is the antitrust environment, because a lot of people are just waking up to realize there's been a sea change in the global antitrust environment. I mean, it's really changed. And the FTC suit earlier this week, or the announcement of a suit against Microsoft on a Microsoft Activision deal, really illustrates that. But the new antitrust sheriffs in town, Lena Khan, Jonathan Kander, FTC justice respectively, have already deterred a lot of deals that would otherwise have gone forward.
Yeah.
I can see that very vividly.
Although I do hear from some of your peers as well, Roger, they're surprised that there is a level of activity where a CEO, for example, has their eye on a particular company, the price has always been too high, and suddenly it's down substantially, and they say, well, here's an opportunity. Maybe I'll send them a letter. Maybe I'll at least inquire as to whether they're interested.
Yeah, I mean, that's a good point, because on any given day or week or month, probably only 10% of possible deals are facing regulatory uncertainty.